Hello and welcome to this month's Tippie Lunch and Learn webinar, Practical Insights from the University of Iowa's Tippie College of Business, served over lunch and ready to use right away. Today's special, tax trends and strategies for 2026. But first, because we know that many of you join us over the lunch hour, we always get things kicked off with a food-themed alum or Tippie connection doing great work. The holiday season is here, and we're giving a festive shout out to Susan and Kevin Felker, longtime members of the Tippie community and the hearts behind Prairie Kitchen Store in Iowa City. This family-owned shop is packed with unique kitchen goodies, local favorites, and treats that make perfect gifts or just a little extra cheer for your own holiday table. They'll even sharpen your knives for carving this year's roast beast. If you're looking for something special this season, it's worth a visit. Check out the Prairie Kitchen Store and say hi to Kevin and Susan. We'd love to hear about your favorite spots with a Tippie connection. Do you have a favorite restaurant run by an alum? Or is there an alum doing things in the food and beverage industry? Drop them into the chat, and we may feature them in a future Lunch and Learn to celebrate our alumni in the food world. Before we dive into today's conversation, here's what's on tap next for the Lunch and Learn menu. Economic Outlook 2026, Trends Shaping the New Year. This January webinar is perfectly timed to give you an edge as we step into 2026. Tippie economics professor Ann Villamil, joined by Tippie alum, will break down what's on the horizon, from shifting interest rates and policy updates to global trade dynamics and labor market trends. You'll gain practical insights to help guide business strategy, investment decisions, and economic planning for the new year ahead. Join us at noon on Tuesday, January 20th, for this engaging live discussion. We'll drop the registration link for this next Lunch and Learn into the chat shortly. And if there's a topic you'd like to see served up by our Tippie faculty in a future session, let us know in the chat. We love hearing your ideas. Speaking of the chat, a question we usually get is today's session being recorded? And the answer is yes. You can find it on Tippie's alumni and lifelong learning pages, as well as our YouTube channel. Past webinars are also free and open to the public, so feel free to share. Now, let's dive into today's main course, Tax Trends and Strategies for 2026, What Businesses Need to Know. Business taxes are shifting fast, from OB3's sweeping changes to the IRS's evolving approach to crypto. As the year wraps up, understanding what's new and what it means for your organization is more important than ever. Tippie tax experts Jaron Wilde and Ryan Wilson are going to break down the biggest trends shaping the business tax landscape. You'll leave with clear expectations of emerging policies, practical insights on complexity at the country level, and smart year-end considerations around capital gains, Roth strategies, loss harvesting, and more. We'll have time for questions at the end. You can submit yours using the Q&A link button below, and feel free to share thoughts in the chat. Now, as you think about questions for the Q&A, one disclaimer to put out there: please keep questions focused on the topics of business, tax trends and strategies, rather than your own personal tax planning. Now, let's get started. Take it away, Jaron.
Thanks so much, Nick. Can you hear me okay? We're good to go there. Fantastic. Well, what a joy to be with you, one and all. Thanks for joining us as we talk a little bit about tax trends and strategies for 2026. When we think about that from a tax perspective for 2026, there's two approaches you can think about there. One is for filing that occurs in 2026, but relates to activities occurring in 2025. So some of what we're going to be talking about would relate, obviously, to that 2025 kind of activities. And then for other things, it would relate specifically to activities that one would do in 2026. Now, to kind of set the stage as we think about taxes, that's not always something that is pleasant in the minds of some. So let's just get a little bit of a sense for what people think. So when you think about taxes or of taxes, what is the first thing that comes to mind? There's a QR code here on the screen. You can go to that QR code and let's just do a little bit of a Mentimeter brainstorm. And then I will pull up here as well for those who don't have access to this QR code for whatever reason. There will be a way to access this so we can get a sense for what's on your mind when you think about taxes. So I'm going to switch really quickly here to this right here. If you go to menti.com and use the code at the top of the screen there, 86359438, that's another way to do it. And we're just going to get a sense as people put in various responses to see what is on your mind with respect to taxes. Stress seems to be a pretty heavy one here. Hate, lots of
Annoying.
money, paying lots of money, how to pay zero. Stress is getting bigger and bigger. Just go ahead and carry on as you.
Where are all the positive words?
I've seen refund. That's usually positive, or money,
Refund.
maybe.
Annoying. Taking my money. Government taking my money.
Too much, too high. I think we have other people who are still joining. We'll just give it just a little bit more time here to see what people are saying here. It seems that stress seems to be the thing that comes out a lot here. Taking my money. Okay, so as we carry on, go ahead and continue to do this. We may or may not, depending on how much time we have, come back to this. But obviously, people tend to feel strongly. That's one way we might say about this. Bureaucratic bloat, deadlines, entertainment, politics. I wonder about the entertainment. I'm curious to know what the thought is there. There's entertainment, how we treat that for tax purposes. Most people, I think, would probably not think of taxes being entertaining, though there's lots of things we could be thinking about. So as we now switch gears here into the topics of the day, let's just begin, and maybe I'll just stop sharing my screen here and we'll switch gears to our next topic here, specifically with respect to cryptocurrency. So cryptocurrency is an area that has received a lot of attention in the media for lots of things, right? And so we'll be talking about cryptocurrency and taxes. When we stop and think about this, when I looked recently, the 2025 tax forms are not yet out. The IRS has not yet produced them, at least as I looked recently, unless they're out very, very recently. And so this is going to be a picture of 2024. So the 1040, the Form 1040, which is the individual tax form that all of us need to file every year for our individual taxes, right? And so this is the 2024 1040. If you look at this at the top, it has some basic information, personal information, your name and that sort of thing, social security number, and so forth. But the first real question of meaning in terms of economics or financial situation is digital assets. And that's striking, right? Because there's lots of things that can be important in our tax situation. In my mind, this may signal a little bit about how seriously the IRS is taking digital assets. And when we talk about digital assets, to make it clear, we're talking about things like cryptocurrency, right? And so the 2024 question specified specifically, did you receive as a reward, an award, or payment for property or services, or sell, exchange, or otherwise dispose of a digital asset or a financial interest in a digital asset? And it's a simple yes or no question. In years previous, I think there may have been some concern about how this question was worded. And so people may have actually said yes to this when they had not actually transacted with it in terms of selling it. So to be clear, if one purchases, let's say, Bitcoin or Ethereum or some other kind of cryptocurrency, that is not a taxable transaction in itself in the sense that you have to pay on any kind of gain or loss. You haven't realized or let alone recognized a gain or a loss for that transaction. But when we dispose of it in some way, whether we exchange it, sell it, and so forth, all of a sudden that becomes taxable. And so we are now required to recognize the gain or loss on that. And so let me give just a little bit of a sense. I was at a little restaurant. It's not even so much a restaurant, it's more like a fast food. It's kind of in between. And I walked in recently and I saw that they had this little ATM where one could actually use Bitcoin to purchase like a hamburger, right? And most people would just say, okay, that's kind of clever, whatever. What I'm thinking about as a tax professor is every time someone does that, that's actually a taxable transaction. And I'm guessing that people who are doing that are not thinking about the fact that, hey, this is actually a taxable transaction. It's as if you took some small portion of selling a security, like a stock in a publicly traded company, and you actually sold a small portion of that. And so it would be a taxable transaction. So if people are doing this a lot, they're actually triggering, in theory, or maybe not even in theory, they're actually required to report on that, right? And recognize the gain or the loss associated with that. And so just something to be thinking about. I'm not here to encourage or discourage anyone from investing in cryptocurrency, but thinking about the tax implications of doing so. And so from a researcher perspective, one of the things that we do is we take data from different sources. One of the sources of those data can be from IRS, so administrative data. And so as we go to the next slide here, one of the things that we have done in a project is taken access to administrative tax data from the Internal Revenue Service with access to over 1 billion tax returns. Now, these are anonymized, so we're not looking at specific individual tax forms here of individuals as much as we're typically looking at anonymized data. But if you were to look at a heat map of the percentage of cryptocurrency sellers by county over time, go back to 2014. This is a few years after the advent of Bitcoin comes out. And you can see, oh, there's a little bit, maybe a little bit in California, on the East Coast, up in the New York area, that sort of thing. There are people who are reporting cryptocurrency sales. And by 2016, it looks pretty similar. Maybe there's a little bit of growth. By 2018, it starts to be a little bit more. We see some darker pockets, primarily in those places, but it starts spreading out. But look, by 2020, this is pretty pervasive. And the reason why we're highlighting this is, to me, this is quite striking. And so, for example, I have this paper we've been working on that is forthcoming in a journal. And one of the things that when I think about that paper is actually this heat map of how much this is really growing, the pervasiveness of this across time by individuals. And these are US taxpayers who are filing with the IRS. And so this is actual data reported to the IRS. So we're not just making this up. This is not inferred. This is what we're actually observing. Now, totally switching gears and talking about something completely different, let's stop and think about our investment opportunities. And by investment, I'm talking about business investment, so capital investment. So as business owners or managers or employees of companies that have to make decisions as to whether to invest, make capital investments, and those capital investments can be things like buying furniture or equipment or what have you. One of the things that we often think about as researchers is the idea that when the tax rate comes down, let's say a country reduces their statutory tax rate, their income tax rate, what that does is it changes the calculus a little bit such that with lower tax rates, companies are more likely to invest, holding all else equal, right? That's pretty natural. And so one of the things that is striking, though, is when we think about that, there are different components of a tax system. One would be the statutory tax rate, the income tax rate that the country is going to impose on income that we earn. But there are other facets of the tax law that can create some complexity. And so does complexity actually introduce a friction where you have this tax rate, but if things are really complex, it actually introduces a friction where companies are less likely to invest. And so if we were just to take this, and this is outside the US because we have access to a lot more data actually outside the US for some things, we see that, hey, there's this increase in investment when you have an announcement of a reduced tax rate. But as we go to the next slide, one of the things that is striking is if we break this into different groups for high complexity and low complexity countries, where you see it is really in the low tax complexity space. And so this high tax complexity introduces a pretty significant friction in how willing companies are to respond to that lower tax rate. Now, why do I bring this up? Well, as companies, as investors, entrepreneurs, owners of companies are making decisions about where to take that investment. Do they take it abroad? And if they do take it abroad, where do they take it? This is just something that may be helpful to keep in mind. Now, as a final kind of topic that I'm going to just cover here in terms of charitable giving, one of the things that we can think about is over the last number of years, we've had a pretty significant increase in the stock market, right? This screenshot shows a negative return, but if you look at over a long, a longer run horizon, we've got a pretty significant growth in many of the securities that we're seeing.
Not in my portfolio,
Not in
Jaron.
your, okay, that, well, Ryan, it's, picking the wrong stocks then, right? But just generally, we're seeing this
Okay.
this overall increase that's going on, right? And so one of the things we might think about is, well, I want to give some money to my favorite charity. And I have a picture here of, one that might be a favorite charity, University of Iowa, right? And so if you were to make a donation to a charity, University of Iowa, a university, a church, some other nonprofit, that sort of thing, what are effective ways to be able to do that that both benefit you from a tax saving standpoint, as well as being able to put you in a position to give more to that charity? So let's say, for example, Ryan, that you had an increase. You say you don't have an increase, but let's pretend for a second that you have an increase.
Nice to pretend.
Yeah, it's good. You
Yeah.
can pretend with me, right? Just
Yeah.
pretend with me that you have this built-in gain, right? So you bought it, let's say for 100, and now it's worth a lot more than 100, okay? Let's also assume that your tax position is such that you can actually claim charitable deductions. And let me just give a side note here. Charitable giving is effective from a tax perspective, primarily when we surpass the standard deduction, right? So if you're below the standard deduction, it's not going to benefit you very much to be able to do that from a tax perspective. It may make you feel warm and fuzzy inside to be able to give. But once we get past that charitable or that standard deduction, what we can do is, if we think about it, there's a couple ways. We could, one, take that security that we've held for longer than a year. We call that long-term property, right? Long-term capital gain property. If you've held it longer than a year, and you could donate it directly to the charity, right? Or you could take that, Ryan, and you could sell it with your brokerage, right? And then you would have to pay the tax on any gain, right? And if it's long-term, you've held it longer than a year, that's a lower rate, right? But you're still going to have to pay the tax on that. But what that does then is you would have less to give to the charity, and then you would have less to actually deduct on your tax return. So if I just show, if you go to this next slide here, for example, this is not to scale, but if you were to donate long-term capital gain property directly to the qualified charity, you've held this property for longer than a year. There are two major benefits of that. One, you do not have to pay tax on the gain. You don't have to worry about paying tax on that capital gain. So that's a huge benefit in and of itself, right? You also receive the full deduction. So that full fair market value of that long-term capital gain property, you get to deduct on your tax return. So you save taxes and the charity receives a larger deduction, or excuse me, a larger donation. Now, if you were to sell that property, one, you'd have to pay tax on the gain, and you would receive a lower tax deduction on your tax return. And then the charity would receive a smaller donation. So really, if you're doing this, especially in larger dollar amounts, it's something for you to think about as you think about this charitable giving in a simple tax efficient way to do so. Ryan, we'll give it to you now to take it away with some tax loss harvesting. I can't hear you,
Pretending
Ryan. I
that
don't
is
know.
something that I
There we
had
go.
actual capital gains. But yeah, anyway, good stuff. Okay, so Jaron's part of the talk was some conceptual stuff. I'm just going to run through some very practical tax tips that many of you may already be aware of, but hopefully these are a few helpful little things to keep front of mind as we close out 2025. So the first thing I'm going to talk about is tax loss harvesting. I asked my very close friend ChatGPT to create a graphic to illustrate tax loss harvesting, and it created this image that you can see here. Image is a little disconcerting, I have to be honest, and doesn't really illustrate anything about tax loss harvesting, but I found it kind of amusing, so I continued to include it. As you'll see later on, my friend did better with some of the other tax concepts. Okay, so what is tax loss harvesting? Well, this is, for better or worse, as I alluded to when Jaron was talking, something I have more experience with, which is what happens when you get to the end of the year and you are sitting on some unrealized losses in your portfolio. So you have some investments that you've made. Those investments have declined in value since you acquired the asset. So you're sitting on an unrealized loss. What can you do with that from a tax perspective to optimize your taxes? And this is, honestly, this is one of the very few things that I actually do in my own life to help minimize taxes. But it's a pretty easy thing to do, and we have some time to do it if you want. So the idea here is that you would sell off these investments to some extent to offset capital gains that you have recognized throughout the year in your portfolio. So that can help you minimize your tax burden during the year by selling off some of your losses near the end of the year. If those losses exceed the gains that you have recognized during the year, you can actually offset $3,000 of ordinary income as well with those losses. So you can reduce your ordinary income by $3,000. You can also offset any of your capital gains by selling off some of your as yet unrealized losses from your portfolio. So let's just kind of walk through how that works. Capital losses are going to offset capital gains. That's pretty intuitive. You offset short-term gains with short-term losses, long-term gains with long-term losses. And then after that, any remaining losses that you have that haven't been soaked up by the gains, then are going to offset ordinary income up to $3,000. So for me personally, I don't like to sell off more, if I can avoid it. I don't want to have excess losses. Those losses do carry forward, so you don't lose them. You can use them to offset gains in future years. But personally, I try to recognize enough of my losses that I can eliminate to the extent possible my gains and take that $3,000 offset against ordinary income. So that's kind of what I shoot for when I do this strategy. And as I said when Jaron was talking, I have a lot of losses. That is a skill I have, is investing in losses. And if somebody wants to talk to me about that, I'm happy to discuss that offline. I seem to have the magic touch there, which is not good. Couple things to keep in mind. Wash sales rule. So, right, you can't go back then if you sell your security. Maybe you really like the investment, but it's declined in value for whatever reason, but you like the long-term prospects of the investment, or you like the role that it plays in your portfolio. You cannot reacquire that asset for 30 days. So that's the wash sales rule. You have to wait for 30 days before reacquiring the asset. So you need to be careful about that. If it's a long-term investment, though, in some asset that you would like to have in your portfolio for the long run, then just wait the 30 days and reacquire it. And in fact, you can use the tax savings to reacquire even more of the asset if you'd like. So, in that respect, it can be a helpful strategy. This is relevant primarily for taxable investment accounts, right? So if your money is sitting in a 401k or a traditional IRA, then this is not a good strategy for you. You should consider transaction costs. So transaction costs these days for trading, stocks and things are relatively low, but I think that's important to consider. If you're doing this properly, you really should acquire an asset to rebalance your portfolio that plays a similar role to the asset that you're selling. So if you're selling an asset with an unrealized loss to recognize the loss, you would want to replace that asset in your portfolio. I don't manage my portfolio that closely, so I don't actually implement this strategy properly. I just sometimes sell off securities with losses to kind of eliminate some of the taxes. But to do it properly, you should rebalance your portfolio with a similar security. But you have to keep in mind the wash sales rule. And I think most importantly, the last thing I would add here is just use common sense, right? It's nice to minimize your taxes a little bit, but the most important thing is to be invested in the securities that you want to be invested in to achieve your long run goals with your portfolio. So, you want to make reasonable decisions here. But still, tax loss harvesting is super useful, and it is one of the few things that I actually practice what I preach and do a bit of that occasionally. Okay. The other thing I want to talk about very briefly is traditional IRAs and Roth IRAs. What are the differences between the two? Again, I went back to my old friend ChatGPT and asked it to illustrate this graphically so I wouldn't have to talk about it. I actually did a better job with this picture, right? So with the traditional IRA, you can see that the dollars are coming in. And to me, that represents that with a traditional IRA, you get the tax benefit when you make the contribution into the IRA. With the Roth IRA, you can see the arrow going up and out. The money is coming out of the savings jar, so to speak. So you get the money, you get the tax benefit with a Roth IRA when you withdraw your savings. So let's walk through this really quickly. So with a traditional IRA, as I'm sure many of you know, you get the tax deduction today, but then when you withdraw the money in the future in retirement, it's taxable. With a Roth IRA, there's no deduction today, but then the investments grow tax-free and they're tax-free on withdrawal. Right? Two alternative investment vehicles. There are annual contribution limits for both accounts. The traditional Roth IRA have a contribution limit of $7,000. You can add an extra catch-up $1,000 if you're over 50. Another important thing to keep in mind is that you have until the filing deadline to make these contributions. A little bit of extra time here with the IRAs. When might a traditional IRA be preferable to a Roth IRA? When you expect lower tax rates in retirement, right? Because you're pulling the money out, you have to pay taxes on the investment at that time when you're in retirement. So if you have a lower tax rate in retirement, the traditional IRA is generally going to be more attractive. I think for most people, that's probably their expectation, but obviously can vary depending on a lot of life circumstances. If getting that immediate tax deduction is valuable to you, then the traditional IRA is going to be better than the Roth IRA. It is essentially achieving income smoothing throughout your career, right? Because during your peak earning years, you're contributing to the traditional IRA and you're getting the tax deduction. And then after you retire, when you're not earning presumably any money from work, then you can pull it out and you pay taxes on the income from the traditional IRA. There's no income limit, but the deductions are going to phase out depending on your income. So you can make contributions to the traditional IRA, but you're not necessarily going to get a tax deduction if your wages are over a certain point. So you need to watch that. The other thing to watch with the traditional IRA is there's minimum distribution requirement beginning at age 73. The Roth IRA is preferable, obviously, if you expect higher tax rates when you retire, which is possible depending on how much money you've saved. If you value tax-free growth and investment, which we do to some extent, there's no required minimum distribution, which is attractive. But the income phase out apply, meaning high income earners can't contribute to the Roth IRA. The other thing to think about is a conversion. You'll hear this talked about a lot, and I'm going to buzz through this pretty quickly, but there's a relatively short window when sometimes it might make sense to convert a traditional IRA into a Roth IRA. And that would usually be a circumstance where you maybe have someone who has had an early retirement, but they're not yet taking their withdrawals out of their retirement account. So they're in a very low tax bracket relative to what they expect to be in when they're in, full retirement and they're taking withdrawals. So during that window, because you have to pay ordinary income taxes when you convert. So you have to pay ordinary income taxes on the entire amount that's converted from the traditional to the Roth. And if you're under age 59 and a half, you actually have to pay a 10% penalty. Now, once you do this, then the funds can grow tax-free and they can be withdrawn tax-free from the Roth IRA. But you'd want to do it at a point in time when your tax rate is relatively low. So there's a small window when a conversion might be a good option.
So Ryan, with the losses in your portfolio, is that what you do? You have these massive losses, and then that's when you choose to do it?
Yeah. Sadly, I've not been good about contributing to any kind of IRA, but if I did and I wanted to do a conversion, I've got plenty of losses in my portfolio, which is don't take investment advice from me. Last topic, which I hit on really briefly, is these college savings accounts, the 529 plans. these are super attractive. They're tax advantage savings vehicles for future educational expenses. They're very similar to a Roth, right? The earnings in these grow tax-free and can be withdrawn tax-free as long as you spend the money on qualified investment expenses for the beneficiary of the 529 plan. Couple other things here. There is no federal deduction for a 529 plan, although the funds grow tax-free and can be withdrawn tax-free. But a lot of the states offer a tax deduction. For example, Iowa offers a deduction up to $5,800 per beneficiary in 2025. So these are quite attractive tax vehicle. And I think maybe what's most important is there's not a limitation here. So most people can avail themselves of these 529 plan benefits. Now, I would add a couple caveats to this. I think you want to use common sense when you're making these contributions, especially if the beneficiary is a long way from college. I think with AI, there are going to be dramatic changes in higher education. It's difficult to predict what the cost of higher education is going to look like once you get out 15 or so years into the future. It could be a lot less or a lot more expensive. Certainly, it's a dynamic environment, to say the least. And so while I think you want to use these plans and contribute some amount to them, don't forget that retirement is the priority. The beneficiary is certainly going to get an education of some kind, but how much they're going to spend on it, I think, if it's a long way in the future, can be up in the air. One thing we can say for sure is you are going to retire. So I think if you're sort of prioritizing between contributing to your retirement or contributing to a 529 plan, my bias would be maybe toward the retirement plan. But these are beneficial, and I think it is useful to save some money for educational expenses through these 529 plans. The state benefits are super generous, and you can continue to get these deductions until you reach a maximum account balance, which in Iowa is pretty generous, $505,000. So 529 plans, another great thing to think about as we get to the end of the year, making your contribution. Get your state tax deduction, and then those savings can grow tax-free. And that's it for me in terms of tax tips. So I guess we're going to take questions now. Okay.
I'm
All
back.
right.
I was just navigating questions. Apologies.
Okay, great. No, you're good.
I didn't want to skip out on you there. But we had some that we got in advance. And a reminder, if you have questions, go ahead and drop them into that Q&A feature right down here at the bottom of the Zoom bar, and we will get to as many of them as you can. And a reminder to keep them focused on the topics of business tax rather than your own personal tax planning. Here's a question that came in advance. Does a company pay taxes if it's held in a trust?
Well, that's an individual tax question in my book.
Okay. There you go. I did not. Good point. I was thinking from the company.
I mean, I think if you had I believe they would pay taxes. Certainly, if there's a tax at the entity level, like if it was a C corporation, they would have to pay taxes, right? Even if you held the shares in a trust.
And then the trust, there would be its own tax return. So for that particular question, my recommendation there is, to visit with, a tax attorney specifically focused in that area. For that, there's going to be lots of nuances in that area.
Very, very good point. We got one earlier that came in that we can kind of, again, look at from a business perspective. And that is on the question of if we donate stock, where is it reported on Form 1040? Is it on an itemized schedule?
Yeah, that's a great question. So I can take that one really quickly. So maybe what I can do is just share my screen here and see, maybe showing us. Can you see that okay?
Yes.
Are you seeing that? Okay, so here's schedule. So essentially you've got schedule 1040. So let me just start here. So you've got your 1040 right here, And then with various things, you've got itemized deductions, right? And so with these itemized deductions, then you're going to go. And so if you go to Schedule A here for the itemized deductions, down here you've got gifts to charity. And there's different kinds, whether it's by cash or check versus other than cash or check. And if you've made any gift of that, and this would be a sizable amount, most likely, if you're donating stock, for example, to a charitable organization, then you have to attach a schedule. So I just have a picture of that right here for you. So you take that and you have to provide the information about the organization, name and the donee organization. And then there's other information, right? How you acquired it, your basis in that, your cost that when you acquired it, and there's probably a little bit more to that, but essentially your cost or adjusted basis, and then the fair market value. This is easiest if it's a publicly traded security, right? So you buy stock in ABC company, you bought it 10 years ago, it is now appreciated in a meaningful way. Then you can take that and donate to that. There are still some judgments you have to make. For example, I know someone who did this fairly recently, and they have to make a judgment as to the fair market value price. So exactly during the day, what's the amount that you're going to allocate for that fair market value price? But this is the basics of what you would do with that one.
So we have another question, and I dropped some others into the chat for you two to look at as well. But NE asks, if a merchant adds an extra amount labeled as tariff expense, can the consumer deduct this amount when they file tax? So again, kind of right on the border of business and consumer perspective, but maybe a little insight there.
Yeah, I'm assuming they mean as an individual, in which case I think the answer would be no. If you were a corporation and you buy supply, you're deducting your costs, right? Your inventory or whatever, supplies, your assets that you acquire, you would depreciate. To me, I believe that would be part of the cost basis of the acquired good. So for a business, I think it would be part of the cost of it, right? I don't think it's a meaningful distinction in the cost. And in fact, I would sort of say it's hard to identify who is bearing the cost of a tariff, right? If it's passed on to the customers, there's a lot of dynamics there that vary by industry. But yeah, so I think in a business context, it would be part of the cost of the item. That's how I would look at it.
Yeah, I completely agree. And that's an important perspective because anything that goes into the service for that inventory, right? So if I'm purchasing things and the cost for me to put that into service, including if I pay sales tax or a tariff or what have you, we're in a dynamic world, right? With tariffs, for example. And so it's not surprising to me that there are merchants who are saying, okay, we're going to add this tariff expense, for example. That's really just a cost of acquisition, right? So if there's a tariff expense, what they're doing is they're making an adjustment and saying, okay, this is the price that we're telling you're paying it for. Then they add this tariff expense. But what they could also just as simply do is say, this is the price of the good. When you buy that, now you're going to capitalize that. And that's important because if you hold on to that for this year, for example, and don't sell it as a business, you don't get to deduct that. It's when you relieve that inventory, in other words, you actually sell that and now it's cost of goods sold, let's say next year, it's in next year that you would actually be able to deduct that on your tax return.
So
And I would be
go ahead.
skeptical of that, how they assessed that was, the cost of, I don't know. I guess I would take it with a grain of salt. To me, it's just all the cost of the good.
There is a question. We were talking about the IRA contributions and such, and again, this might skate into the individual side of things, but I'll let you two be the judge. At what age do I have to start withdrawing from an IRA, and is it advantageous to donate to a charity directly from an IRA?
I believe the age is 73 that you have to start withdrawing the minimum requirements from the traditional IRA, not from the Roth. I think you'd have to, I wouldn't know on the second question. what you can do there in terms of contributions.
I can take another one here, Nick, that I see just in the
Okay.
chat here.
Yep,
That's
go ahead.
it sounds like someone's had a rough, very rough year here and is asking what resources other than the IRS website and tax forms can guide me to see what forms to file and so forth. So one possibility that I'll just make available, and let me just share my screen here as well, because this may be helpful. And I can pop it in there, but I'll just share it for just a second. So can you see this, the VITA website here?
Yes.
So there's this volunteer income tax assistance, and these are essentially affiliated, often, for example, with a university where individuals can go and they can receive free income tax assistance. And so there's typically someone who oversees that, and there could be even students, accounting students or what have you, who are volunteering their time to be able to assist individuals with their tax filings, right? And so one resource that may be available that could be helpful is go into the VITA here, and I'll just pop this in the chat so that it's available. And then there's a website here, and it gives you information. February 1st through April 9th, Johnson County will provide taxpayer assistance and so forth, and it tells you the times and that sort of thing. And so that may be one resource that could be helpful to you as you do that. Now, that's a free form of assistance. They are not experts. These are not individuals who are tax attorneys who specialize in lots of different things, but they will have some resources that can be helpful to individuals trying to navigate, especially with difficult circumstances along those lines. Hopefully that's helpful to you.
Excellent. And I'm just getting caught up with what's come in, and we've also got some in the core chat too, that are there. We got to that one. These are some personal ones.
We recognize that a lot of the questions individuals will have will be personal by, the nature of
Yeah.
them.
And we've got another one because we were talking about Roths earlier. When is Roth IRA conversion advisable, and when is it better to hold off?
I generally think about converting from a traditional to a Roth. I'm not sure I haven't thought much about the other way around. I don't know. Yeah, I don't know, Nick. I'm sorry. I wouldn't.
Yeah, so typically there's kind of two big structure pictures how we can think about these. It depends on the situation, but you've got traditional, you've got Roth, and there's conversions from traditional Roth, and that's what Ryan was really talking about. Now, you pay taxes when you do that, right? So then the question is, if it does it make sense to pay all that tax now? And Ryan went through this, but I want to just emphasize one of the things that comes through here is there's a lot of assumptions that you have to think about. You have to think about what is the income tax bracket you're going to be in when you're in retirement. And that is a function of a couple of things, what your personal income is going to be, but also what future tax rates are going to be. And so Ryan and I, if you gave us the numbers, we can run those numbers, yeah. But no one actually knows what those numbers are because that's a function of the political process. So let's say someone's going to retire in 15 years, right? Well, we don't know what the tax rates are going to be like in 15 years. And so all of these are kind of mental exercises based on our best assumptions, but it's very difficult to know what is actually going to be. How much is that account going to grow? How much will there be an appreciation? How much or how high will the tax rates be at that time, both state level and federal? And so there's lots of things that you can think about. So my recommendation along those lines, that's just kind of a simple recommendation, is give some thought as to what you think things are going to be like when you are about to retire and how much it's going to grow, and then make a decision based on that from there. I know I didn't tell you anything with that, and that's kind of by design, but it's just an exercise all of us have to go through in making these decisions, actually.
A lot about your consumption patterns too, and what you expect your cash flow needs to be over the arc of your life, which is difficult. So
Yeah.
you got a lot of balls in the air to think about there, which makes the planning
I
complex.
I dropped some additional questions into the chat. If you see any there that you want to, uh,
Somebody asked you, do you recommend an attorney or a CPA? I think that has to do with the complexity of what you're doing. So to me, if you're just sort of normal, recurring, everyday life events, having a child, selling a house, moving, getting a job, changing jobs, things that give a lot of us anxiety when we're filing our taxes, then I think using a CPA is ideal. I think if you're starting to think about bigger tax planning things like setting up a trust, a very large charitable contribution, you know, those kind of things, then I think, generational transfers of wealth, then I think you're probably going to go to a tax attorney. Would you agree with that, Jaron? That's kind of my.
Yeah, I think it depends on the nature of the question. So, for example, if you're engaged in things like 1031 transactions, and if you don't know what a 1031 transaction is, then it suggests you probably don't need a tax attorney for that 1031. But if you're doing a lot of property tax stuff, for example, where you're buying and selling property, if you're engaged in that, it may be worth actually learning a little bit about, just look it up, section 1031, 1031. And often you would be inclined probably to use an attorney, a 1031 attorney, if you're engaged in that sort of thing. If you're doing major estate planning, if the basket of your estate is really a sizable amount, then it's probably worth the attorney. For regular things like you have a small business, or you have your own personal income tax kind of situation, a CPA is going to be a good route to go. You would not need the services specifically of an attorney. Now, they all can do tax things, but they tend to focus often on different areas. So I hope that's helpful. Um, there's a question here, Nick, about how do you recommend business owners with inconsistent income plan for estimated payments if they're not on payroll? The way I'm understanding that, obviously we can't have the back and forth here, but what I'm understanding here is maybe we have a small business owner and the income based on their particular business is not just the set amount. It goes up and down accordingly. And that's a difficult thing, but with those estimated payments, the one way you might think about this is what do you think it's going to be over the course of a year, right? What do you think the amount of the income is going to be and make payments accordingly? And then there's true ups, like when you do corporate estimated payments, for example, you're going to be taking this and you have to use information that you have so far, and then you annualize that, as I recall, to be able to take and make those payments in that quarterly way. And so you just do the best you can. If you overpay, the downside of that is you're not using that cash yourself. The upside of that is you get a refund, right? And so it's not an
If
efficient
you're
way, but
if you're large enough, Jaron, you can scale the payments by your profitability each
sure.
quarter. And then the other thing is there should be a safe harbor. I believe there's a safe harbor based on the prior year. So as long as you're paying in proportion to your income from the prior year, I think you're under safe harbor.
Yeah.
But you have to look into the rules specifically because I think there are thresholds that might change those requirements.
There's another question here about how is crypto being treated tax-wise by different governments versus the US? I don't know how every country is doing it. I know at one point at least, and it may still be the case, there was more than one country that had actually adopted Bitcoin, for example, as like an official currency. And so they would be even more favorable than the US. Now, the dynamic of the political environment surrounding digital assets is dynamic, right? Different administrations may treat it or think about it in a different way. And so it's difficult for me to say just US versus non-US. But the thing that I hope we have emphasized is we need to be thinking about our own tax situation. If we aren't invested in cryptocurrency, it's not like it's just the sort of thing that you can just invest in, buy and sell a bunch of times and never have any kind of tax consequences, because it is an area that obviously the IRS is interested in. And the only evidence I'm giving you that's really clear is it's like that top question. I'm not going to go into more details than that.
Well, Oh, Ryan, what was that?
Well, it's interesting to think about conceptually because we're saying it's a currency, right? You don't, if the dollar is inflated or deflated, you don't pay gains on the purchasing power of your dollar increasing or decreasing. But when it comes to crypto, there are tax consequences in the US if you sell it at a gain. So it's funny, we tax it as an investment, we talk about it as a currency, other countries treat it as a currency. I don't know what the right answer is. I don't have any crypto in my portfolio, but it's a fascinating question for sure. Yeah, from a tax policy perspective.
So, thank you both for your knowledge, your incredible presentation. But before we wrap up, we always close our Tippy Leads podcast by asking our guests for a final tip E, a practical takeaway our attendees can apply right away, even if it's just thinking about something differently. So, as we look ahead to tax trends and strategies in the new year, what's one thing that you'd recommend?
Maybe I can just jump in and see, that we started by asking when you think about of taxes, what is the first thing that comes to mind? And the number one thing is stress from what I can see. And the number two thing is deadlines. And then there's other strong language about it, most of it not very positive, right? And that's very understandable. I
Yeah.
hope that as part of this conversation we've had here, that we can start thinking about taxes a little bit in terms of what can I do? I can't change the fact that we have to pay taxes, right? I can't change the fact that I have to file taxes every year, just like everybody else, right? But can we use in very legal ways the tax law such that it actually is beneficial to us with our charitable giving, with our 529 plans, with our retirement planning, and so forth, thinking a little bit more proactively at utilizing what we have in the tax law that can be beneficial to us, or at least the most efficient use or approach to it, rather than just the dread. We're going to dread it no matter what. But can we actually use it in a way that is, in the long run, maybe beneficial as well, both to us as well as to others?
All
Yeah.
right. Oh, go
And
ahead.
I think for me, I would just say think macro a little bit. There's an interesting dynamic developing where we have these enormous deficits, right? And so I think that's going to have pretty clear implications for tax policy as we try to service interest on these huge deficits. So if you're planning long run and thinking about some of these things, some of these investment vehicles, what is going to happen to tax rates in the future, I think it's important to bear in mind, there's some constraints on where those rates can go given the size of these deficits. Now we could grow our way out of that economically, but whether we're able to do that, I think it's definitely an open question. So that's going to inform tax policy in the future. And it's also going to constrain tax policy in a way that I don't think we've ever had that before in the US. So it's going to be an interesting dynamic over the next 10 years.
All righty, we will have to end it there for today. Remember that this session has been recorded and will be available on the Tippie alumni and lifelong learning pages, as well as our YouTube channel. And be sure to join us next month for Economic Outlook 2026, featuring Tippie Professor Ann Villamil providing an insightful look at the economy, key trends, and what businesses and leaders should watch as we move into the new year. It's coming up on Tuesday, January 20th at noon. The sign-up link is in the chat. Right after the webinar, a brief survey will appear in your browser. We'd greatly appreciate it if you could take a moment to share your feedback to help us improve future programs. On behalf of everyone at Tippie, thanks for listening, and go Hawks.